If you own rental property or you are interested in owning rental property at some point in the future, then listen up, because this tax strategy can save you tens of thousands of dollars in taxes. And this strategy involves you qualifying as a real estate professional, which gives you massive tax benefits that ordinary taxpayers cannot take advantage of. And by the way, when I say real estate professional, I am not referring to any formal real estate license at all. You do not have to be a real estate agent, broker, or anything like that to qualify for the IRS's definition of a real estate professional. You just have to satisfy 2 IRS requirements, and then you can use this strategy to save thousands of dollars in taxes. And I am going to fully explain everything to you in this video. If you're new here, my name is Sherman the CPA, and I tax plan every single day for high income business owners over at mycpacoach.com. A lot of my clients want to invest in real estate to offset their earned income from their business or their W-2 job, which allows them to pay less taxes. And the path to accomplish this normally requires them to qualify as a real estate professional, which is what this video is all about. So if you stick around for this full episode, you are going to learn the #1 obstacle to using rentals to reduce your taxes and how qualifying as a real estate professional helps you get around it. And then we'll talk about what a real estate professional is according to the IRS and the primary requirements to qualify as one. All right, so let's jump right into this. All right, so first, let's address why this strategy even exists in the first place. Let's talk about the #1 obstacle to using rental properties to reduce your taxes. So normally, high-income taxpayers want to use rental properties to reduce their income taxes. And that is because, well, real estate depreciates. And depreciation is a non-cash expense that you can claim on your tax return as a tax deduction. And to add to that, savvy real estate investors who understand the tax law accelerate this expense with a cost segregation study to take an even larger deduction. So normally, taking all of this depreciation expense actually creates a tax loss on paper for most real estate investors. And that tax loss is what most taxpayers want to use to offset other income on their tax return to pay less taxes. Now, the biggest obstacle they run into is something called passive activity loss limitations. The IRS says that losses from passive activities that exceed income from keyword passive activities are disallowed. So let's break this all the way down. On one hand, real estate is considered passive income, which typically generates a loss. And then on the other hand, money earned from your W-2 or your business is considered earned income. Now, both of these types of income are treated differently for tax purposes. And what the IRS is saying here is that you cannot use passive losses to offset earned income. So then you're probably wondering, well, what can you do? Well, there is one simple solution to this problem. Turn your rental income into earned income. And you can do this by qualifying as a real estate professional. The IRS says that if you qualify as a real estate professional, your rental activities in which you materially participate in are not passive activities. So basically, this allows you to turn your passive rental loss into an ordinary loss that can be used to offset your business and W-2 income. For example, let's say you earn $300,000 per year in earned income, and you recently purchased a $400,000 rental property. And let's say that property earned $10,000 in rental income, and you have an $80,000 depreciation deduction from taking accelerated depreciation, leaving you with $70,000 in rental losses. Well, if you qualify as a real estate professional, then you could use that $70,000 loss to offset $300,000 in earned income. Which means instead of paying income tax on $300,000, you would only pay income tax on $230,000. And that difference would save you over $20,000 in taxes if your effective tax rate is 30%. With that said, let's talk about what exactly a real estate professional is and how you can qualify for one. So a real estate professional in tax terms is simply a tax status. And if you meet two simple requirements, you can qualify for this tax status. So let's talk about those two requirements. Number one, more than half of all of the personal services you perform in all trades or businesses must be performed in rental properties where you materially participate. Or in other words, you would have to take the position that you work on your real estate business more than any other business activity that you are currently engaged in. For example, let's say you work 15 hours per week as a freelancer or as a part-time employee. Well, to qualify in that case, you would only have to work 16 hours per week on your rental business to meet this test. Whereas if you work a full-time job working 40 hours per week, then you would have to work 41 hours on your rental business, which could be a hard argument to make. But if that's you, do not get discouraged because there are a couple of workarounds for this, which I will discuss in just a moment here, but let's quickly address the next requirement first. Requirement number two, you have to have worked at least 750 hours during the tax year where you materially participated, which comes out to be about 15 hours per week. But there is no weekly requirement per se. You would just have to work at least 750 hours per year in your rental business to meet this requirement. With that said, these two requirements are pretty straightforward. And if you qualify, great. If not, let's talk about two creative workarounds for qualifying for this. Now, the easiest workaround for those who are married could be to have your spouse qualify as the real estate professional. If your spouse does not work, you could have him or her perform services for your rental properties to meet this requirement. And even if your spouse does work, I have seen instances where my clients have justified having their spouse leave their job because the tax benefits of this strategy outweighed his or her compensation. Now, this is ideally something that you would work with your tax professional on so that you can weigh the pros and cons and make a careful decision. But the bottom line here is that if your spouse qualifies and you file a joint return with your spouse, then you could use his or her rental losses to offset your earned income. So that's the first workaround, but maybe that's not possible for you. Perhaps you're not married or it doesn't really make sense to leave your job. I get it. So let's talk about another alternative. And this alternative does not require you to actually qualify as a real estate professional. This involves you using a short-term rental strategy. Now, short-term rentals are not subject to passive activity loss rules, which means if you Airbnb your property, for example, you can use those losses to offset your earned income. The IRS says your activity is not a rental property if any of the following two conditions apply. Number one, customers use your property for less than 7 days. Or number two, you provide significant personal services within those rentals. So if you are investing in short-term rental property, you should be able to use your losses against your ordinary income if you're doing this correctly. Or you may even consider converting one of your properties into a short-term rental to take advantage of these tax benefits. As always, thank you for watching this video. If you enjoyed it, let me know by clicking the thumbs up button below, drop a comment and ask any questions you may have, and be sure to subscribe to our channel if you want more videos just like this. Oh, and by the way, if you're interested in working with me directly, then consider applying to become an exclusive client of mine over at mycpacoach.com. Thank you, and I look forward to seeing you in the next episode.